So good morning, everybody. So I wanted to pick up on and finish up chapter 13 this morning. And basically, we left off on this slide. And I'll go back a slide. And here was the probability distribution with different debt ratios, right? So if we go back a little, here's the different capital structure. And here's the standard deviation and the expected earnings per share. Remember, the higher the standard deviation or the coefficient of variation, the more risk you're taking. And you can see that going up as we take on more debt risk. Okay, so that's showing that here, right? Here, this is more risky. It's more spread out, higher standard deviation, higher coefficient of variation. Now, this slide here is where we left off. Look at the expected earnings per share going up as we take on more debt. So far it looks good, right? And then all of a sudden we have too much debt, and there's a point where you start to lose earnings per share because you got to start paying the interest back, and the interest on the debt is starting to swamp you. So the earnings per share go up. So at 60% debt ratio, your earnings per share start going down. So if we look at this, here's 60% debt ratio. Look at the earnings per share right here going down. Notice how they keep going up, 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 and then they drop right here. Okay? So there's a point at which too much debt starts to swamp you and it's no good. And here is your overall risk, right? With it, as you take on more debt though, here's your risk going up, right? Here's the risk going up. And right here's your business risk, which is constant all the time, right? And your financial risk is going up because you're taking on more debt. All right, so then the question is, what's the optimal capital structure? In our case, we saw it was what? We saw it was, in this case, 50%, right? Earnings per share, right? And so if we go back to this equation, here is the value of a firm is equal to the present value, and this is very, very important, of its future cash flows, right? And it goes for all of us too, right? The present values of any of us is equal to the future value of future cash flows, the present value, I'm sorry. So it follows that the value of the company is maximized when the cost of capital is minimized, right? So the value of the firm is equal to earnings before interest and taxes times 1 minus the taxes all over the weighted average cost of capital. So this is why you want this minimized, because this will go up. And this numerator is the same as what's called NOPAT, net operating profit before amortization and taxes, right? So this is also called net operating profit after taxes, right? Net operating profit after taxes. And that's just equal to EBIT times 1 minus the tax rate. So you can see here, here's the cost function of that equation, and it's maximized right here at the optimal capital structure is right here. And this here is the basically somewhat like the sum of these three. Here's your cost of debt, right, which is low, right? Here's your weighted average cost of capital. And here is your cost of equity. So the weighted average cost of capital is the combination of the cost of equity and the cost of debt. And you'll notice this is a minimal here. When this is a minimum, right there, see that's a minimum, the red curve. And then this will be a maximum, your value. So the blue and the dark and light blue make up the weighted average cost of capital, and it's minimized at this point, and it's at this debt to total assets level, and that maximizes your value. So here's another way of looking at it. You compare your EBIT to your earnings per share approach, and here's the different debt ratios. And here's your financial break-even point for each one. And you'll notice here the financial break-even point is 0 for the debt ratio of 0. And at the 30% level, it's $50,000. So you can clearly see that what they're plotting here is different debt ratios and different EBITs and the earnings per share here. So here's your earnings per share. Okay, of 100,000 and of 200,000, and of EBIT, and here's the different earnings per share. So at 60%, your EBIT is $3.03 with a 60% debt ratio, and at 200,000 it's 903. Okay, so here's your EBIT, right? So 200,000, and you can see that typically is $9.03. All right, so just to summarize some of the important points here, the most important point to recognize when using EBIT, earnings per share analysis, is that this technique tends to concentrate on maximizing earnings rather than maximizing earners' wealth. So basically you try to maximize the earnings here and not the stock price. Right? The use of an earnings per share maximizing approach ignores risk. Right? So we're ignoring risk here. So because risk premiums increase with increase in financial leverage, the maximization of earnings per share does not ensure owner wealth maximization. So you're taking on more risk, okay? So one has to be careful with that. All right, so here is the different capital structure, the amount of debt we're taking on, the amount of bonds from 0 to 60%. And here's the coefficient of variation, right? And you'll notice that's going up, right? That's more, so the higher this number goes, the greater the risk. Everyone see that? So this is going up, and if you want more risk, you need more return. So your estimated required return will be going up accordingly here. So the higher the risk, as you can see, the higher the return. All right, so the value of the company, as determined by the share price, right, can be estimated by using one of the standard valuation models, and everyone has seen this already, right? From Business 330, this is the zero growth model, and then you can see they mention that right here, zero growth model. So so you basically there's different models, right? So although some relationships exist between expected profit and value, there's no reason to believe that profit maximizing strategies necessarily result in wealth maximization. Right? So this is normally shown with a dividend value, but here they're showing it with the earnings per share. All right, so again, here's the capital structure, right, going from no debt to 60% debt. Here's the expected earnings per share, and we saw this table already. Here you start dropping, and here's your required return, right? Your estimated required all the way up to 19%. And you'll notice the estimated share value, it doesn't necessarily continue to go up, right? If you follow this, look, it goes up, 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 and then it begins to drop off. So this is the estimated share value. So maximizing required return here doesn't necessarily mean that you're going to maximize your share value and maximize shareholder wealth. So here's maximized share value here, and here's the maximized earnings per share. And you'll notice with different debt ratios, they don't match up. Okay, so these so maximizing this doesn't necessarily mean you're going to maximize the stock value for the shareholders. All right, so here's a couple points on different types of risk And you should read this and understand these different risks. All right, and all right, so that's about it for chapter 13, and I'll move on to 14. Everybody have a good day.